All right, hey, everybody, Jesse Lipscomb here. Welcome to Tax Planning for Homeowners and Real Estate Investors. Our host today, Jeneane Mason. She's a realtor with Coldwell Banker in San Diego. Jeneane, how are we doing today?
Oh my gosh, I'm doing so great, Jess. Thanks so much for taking the time to meet with us today. I'm so excited about going through this tax information.
My pleasure. And for those that don't know me, Jesse Lipscomb, an enrolled agent and investment advisor in San Diego. We do tax planning for real estate agents and real estate investors. Today, we're going to talk about real estate taxes and strategies. This is the most dynamic real estate market I've ever seen. I mean,
Yeah,
right? I've heard of homes going for $50,000, $100,000 even over asking.
absolutely. Absolutely. It's a very interesting time. And that's
Yeah,
why we need some solid advice for our clients to be making decisions from.
amen. And we need to know, what your options are. Can you sell it? Are you going to be able to defer any of the taxes? Let's talk about some of the new strategies out there. Also, hey, Jeneane, is it a good idea to sell my home today?
Oh my gosh, Jesse, absolutely. Today's market, there's the demand for housing is far exceeding the eligible inventory, making it a really good time. And honestly, interest rates are so low. It's a great time to sell. Interest rates are so low that it's also a great time to buy. So we've got this really interesting dichotomy going on.
Right. And this is, love Zillow or hate them. It's good for regular data. Since about 2013, doesn't matter what part of the county we're in, there's been an upward trend, but nothing crazy. But look at just since last year, look at that. I mean, that's almost, 70, 80 degrees upward trends. I
Yeah.
definitely think that it's a great opportunity for folks if they're looking to sell.
Absolutely, and I'm happy to run an analysis similar to this for most any neighborhood in San Diego, and you all see the upward trend line.
Okay, well, let's dig into it a little bit. All right, so selling your home. Most people are familiar with the 2 of 5 year, $250,000, $500,000 exclusion, but I also know that this rule is completely misunderstood. Okay, and we're going to go over some of the do's and the don'ts. The key is you really have to own the home for at least 2 years as both owner and resident. If you just do that, if you own it for 2 years, bam, 250,000, 500,000 if you're married, you can protect from capital gains. However, there's always but. And one of those buts in the last year has been, well, what if I can't be in the home for 2 years? Well, typically, there's 3 main exemptions that we work with: military, work-related moves, and health-related moves. Each of the first 3, Jeneane, are based upon a 50-mile move. So
Okay.
if you're called up on extended military duty where you're active duty for at least 90 days and 50 miles away from home, okay, or a work-related move over 50 miles, health-related to take care of yourself, a family member, whatever, 50 miles is kind of like that key. For our military folks here in town, the stop the clock aspect of this is the best thing you've got. And so easiest example I can give you, you buy the house in 2014, okay? And you live in the house for 2 years, 2014, 15, and 16. 2016, after your second year, you get orders to I don't know where, but it's at least 50 miles away.
Okay.
So now from 2016 till 2021, there's 5 years there. So really, you haven't lived in the house for 2 of the last 5 years, right?
Right.
But with the military, they get to stop the clock for up to 10 years and say, no. The last 5 years don't count. I'm going to sell my home with today's values and yesterday's purchase price as if I lived there for the last 2 years. And the only caveat there is, typically what folks do when they get sent out of town is they're going to rent it out. And so if you've rented the house in the last 5 years or however long it's been, we're just going to reduce what you bought it for by the amount of depreciation you took. But with that, I mean, that's military really has a good deal going there. I've seen a lot of people have to relocate because of taking care of a family member during COVID. Um,
Okay.
but
Yep,
the
absolutely.
unforeseeable events section is really what we're seeing the most right now. And what that means is just things you couldn't predict, whether you know, God forbid the death of your spouse, but a divorce. Unfortunately, that's happening a lot. There's a lot of families that, you know, were okay when they were both working outside the home, and now they're with each other all the time. They're like, we need a break. Okay, and then the last one is unemployment eligibility. The key
Mhm.
word there is eligibility, not whether you
Okay.
took it or not. And so if you've become unable because of change in employment status or anything else to pay for your basic living needs, that happened to a lot of people last year. I mean, especially if you actually did lose your job, you may be able to utilize the unforeseeable events exemption. So let's talk about in real dollars what happens. So March of last year, right before it got too crazy, you bought a house for $600,000. A
Okay.
year later, you lose your job, and it's a COVID-related loss. Okay,
Mhm.
that housing has gone up a lot in the last year. It's now you sell it for $200,000 more than you bought it for, but you've only been there 1 year. You've only been there
Uh,
12 months.
right, exactly.
So you haven't hit the 2 year mark. What do? Well, because you sold the property in conjunction with the COVID-related job loss, you get to say, okay, well, 12 months of ownership out of 2 years is what? Out of 24 months, that's 50%. So if you're married, you could protect up to $500,000 of the gain. 50% of $500,000 is $250,000. But it was only a $200,000 gain. Therefore, you don't pay any taxes,
Oh, for goodness sakes.
right? So
Right?
this is and it's called the unforeseeable events. Okay, this is a huge exemption for homeowners of primary residences if their situation has changed because of the uncertainty, you know, all the different things going on. Okay, now this is probably the point of real estate and taxes that is least understood and most often done incorrectly. Okay, so what we're going to talk about right now are what people used to do and what you're not going to do anymore. All right.
Oh,
What
perfect.
people used to do is they used to get a rental property and 1031 and 1031 and 1031 and then want to sell it and move back in for 2 years and then apply the $500,000 exclusion, sell it without paying a bunch of taxes.
Exactly. Yep.
Great strategy. Doesn't work anymore, but it used to be a great strategy. In January 1st, 2009, the rules changed to introduce a concept called non-qualified use. It's really a proportionality clause. And basically, without overcomplicating it, it is figure out how long you've owned it, figure out what part of the time you rented it, and that percentage of the time doesn't qualify. Okay? So
Okay.
let's go over some numbers. And I see the gears turning here. Let's just
Yeah.
Yep. Oh, by the way, don't move back in. Don't
Okay.
do it. Okay,
Don't do
it.
it.
All right.
Okay. Got it.
If you buy a house for $500,000 in 2010 and immediately start renting it out, never have lived there.
Right.
2018, you're like, you know what? Let's sell this. Let's move back in.
Okay.
2020, you sell it for $1 million. You got a $500,000 gain there. Pretty awesome.
Yep.
But 8 of 10 years was a rental. 80% of that $500,000 is not eligible for exclusion under Section 121 primary residence, even though you lived there for 2 years. And even though the gain was only $500,000, you only lived in there 20% of the time, which means only $100,000 is eligible for the primary residence exclusion.
So Jess, this is so valuable. This is, you're absolutely correct, just so misunderstood. I talk to clients all the time that think, yep, I'll just move back in, live there for 2 years and then sell. There are still huge ramifications.
Don't do it. Okay.
So what are we going to do instead?
So we actually have we have 3 primary strategies that are all going to dovetail on top of each other. And when I say
Okay.
strategies, we're going to look at sections 121, 453, and 1031, and how you can utilize those kind of parts of each to do what you want to do, right? Sell today and minimize your taxes. But the only reason you move back into a rental, the only reason is because you want to live there.
Okay.
That
No.
there are no tax negatives for you to move back into a rental if you actually want to live there. But don't think then you're going to be able to sell it and protect the gain. It actually, if you move back in for 2 years, say, and then you want to sell it, well, now you can't do our next strategy, the 1031 exchange. Because
Okay.
you can't 1031 exchange with primary residence, right?
Right. Exactly.
A 1031 exchange is great. It's like playing Monopoly, right? You buy the smaller properties and then you trade them up to something better, and that's how you're accumulating wealth. But in the life cycle of any real estate investor, you have a time for accumulation and then distribution or getting rid of headaches, right? But the
Right.
1031 exchange, if you're still in the game, pretty easy. You got 45 days to identify a new property and 180 days to close. The 180 to close historically hasn't been that hard, but in a real estate market where you're getting 20 offers on a property,
Yes.
we're finding a lot of people are going to sell their 30-year-old rental for $1 million and take that $1 million and buy 4 $250,000 properties in the Midwest, brand new. And that's not a bad strategy, but it does come with a catch. And that is California wants to be with you forever. Okay. And if you sell a California property and you buy out of state, every year you're going to continue to have to file a California Form 3840 regardless. And the only time that you don't have to file that, and your tax guy should know this, but the only time you don't have to file it is if you either die, donate the new property to charity, or you just decide to pay taxes on the gains, which doesn't make any sense, but sometimes it happens. So, and don't take my word for it. The right there's a link. This is from the FTB website. It literally says in government talk exactly what I just said. Okay. The only difference is it also says here that we will issue a notice of proposed assessment if you don't file the form. Now, a notice of proposed assessment is a guilty verdict that you have to fight to overcome. So let's say you get $1 million gain on a property and you 1031 exchange it out of state. You're not filing the 3840s. California's just going to say, oh, well, here's to us, you got $1 million gain. There's $100,000 in taxes due. Go ahead and send that in. And you're going to say, oh, wait a minute, I don't owe that. Yeah, well. So that 3840 is very important. Okay.
So you either file the 3840 or you pay the taxes on the proceeds, the gains. Yep.
And think about that.
Yeah.
You're doing a federal 1031 exchange, a federally qualified deferred exchange. Yet California will assess you taxes on that for failure to file a form. That's a pretty interesting situation. Okay.
Yes.
All right. So what if you get to a point where you are tired of toilets, tents, and trash, and you want to sell that rental, but you're going to lose too much money in capital gains? Well,
There's this question all the time.
It's the old-timey installment sale. This is the section 453. I'm going to tell you all the good and all the bad. Okay. The good is that when you sell a property and you do a seller carry, essentially, you only pay taxes on the payments that you receive. So easy math. You have a $500,000 gain. You do a 10-year note. They pay you $50,000 a year. You're only going to pay taxes on $50,000 a year for 10 years.
Okay. So you become a lender instead of a landlord. You hold the note.
Right. That's exactly right. And why would somebody do that? Simple. Because the capital gains brackets up to 80,000 married is 0%.
Okay.
So if, let's say your married income, Social Security and rents, and you sell the rental, so long as your taxable income's 80,000 or less, the long-term capital gains on the sale of that rental will be actually 0% sold through an installment sale. It's pretty awesome. It's a powerful strategy. It doesn't always work. It depends on the situation, but it works really well when it does. Now, there are two huge negatives. And I think everybody listening to this, watching this, sees the first one saying, oh my God, what if they don't pay? Well, then
Absolutely. That can be the first question. Yes.
and that's horrible. The good thing is you do get the property back. The bad is usually they've mismanaged it. It's not ideal. But what's worse is when they prepay you. Okay? Interest rates are the lowest they've ever been. If you're carrying, you know, you've got a 10-year note, you're the note holder, it's at 6%. Interest rates are now at 2% or 3%. They get from the bank and they pay you off in year 5 right there. And all of a sudden, all your taxes are due. So,
wow.
But those are two legitimate negatives with a very big positive. So how do you know, what's the balance there? Well, our solution is a trademark strategy called the Deferred Sales Trust. And what it is a business trust that the seller enters into in exchange for a note. So I'm going to sell the trust, my house, in exchange for a note, but it's contingent upon the trust selling the house to an outside buyer for cash. And when I say cash, I don't care about the outside buyer's finances. They can bring in cash, they can bring in credit, they can bring a combination of them. It doesn't matter.
Okay.
It just means that the property is sold to an outside buyer, arm's length, unrelated, and there's literally physically money in the bank. With having money in the bank, then the payments begin to the seller. Now, with having money in the bank, the threats of not getting paid and or being paid earlier than expected, they're neutralized, because whereas the Deferred Sales Trust is a third-party trust, it has a professional trustee, and it is
Right.
arm's length. So they're still friendlies. I mean, there's oversight. You've got an investment advisor on it. You've got a trustee looking at it. You can't take money out of the accounts without your signature. I mean, there's a lot of redundancies built into it. But for the right person, that person who is what? Who's tired of toilets, tennis, and trash, and they want, they're done. This is a really powerful strategy. So let's actually go over a couple of real examples. Let's just look at a $900,000 sale. You bought the house for $500,000. It doesn't matter when. It could be last year, it could be 10 years ago. It doesn't matter. You bought it for $500,000. You have a $400,000 gain. Now, if you're married and you're making about $120,000 a year, you sell that and you have a $400,000 gain, you're going to pay 15% IRS long-term capital gains. Some of the money will be assessed an additional 3.8% Medicare surtax. California is going to withhold on investment properties 3.3% of the gross sale, i.e. the $900,000. Now, when you do your taxes, you may or may not get that back. You might get it all back. You might end up owing, but that's what California does. They take it. So the point is, if you have a $900,000 sale, you own it free and clear, you're going to get a $99,000 haircut, $100,000 haircut basically. And if you took that $800,000 remaining, somehow, some way, you could get 3% interest on that money. Now you've got $2,000 a month of monthly income.
Okay.
And there's nothing wrong with that. The problem is you're not you don't have a situation where you're getting both principal and interest. With the Deferred Sales Trust, you don't get the $99,000 haircut, and you can take that $886, given the same interest rate. Maybe we do a 20-year fully amortized note. Now you're getting $4,900 a month instead of $2,000 a month. Yes, some of that $4,900 is going to be what? Gains.
Taxable or gains. Okay.
Taxable gains. But
Taxable gains.
the trick here is what? If we multiply out $5,000 a month times 12, that's $60,000 a year, right? So we know that the total payments are going to be just shy of $60,000. Well, depending upon how your personal taxes go, you may still find yourself in the 0% bracket on this.
Sure.
You know,
Sure.
we all live on income. We don't live on assets. Now, assets produce income, but just because you've got $800,000 in the bank, you need a monthly income on that. And how much the better if utilizing a fully amortized deferred sales trust note, we're able to take control of some of those taxes. Ultimately, you may end up paying some of those taxes, but at least you don't get that big haircut right out of the gate.
Got it. Yep. That sounds amazing. And just how many people would you say actually, how common is that people are well informed and able to take advantage of this?
How common are they well informed and able to take advantage? Those are two separate things. Okay.
Okay.
Well informed on it. I don't think it's as prevalent as it should be. Jeneane, I think everybody, whether rightfully or wrongfully, I think everybody has at least heard of the 2 to 5 year exclusion. I think there's section 121 where you can use 121 to sell your primary residence. Okay, you can use it and it works so long as you've owned it 2 of the last 5 years. You know, if you get the non-qualified use situation in there, very few people understand this. Even a lot of tax people don't understand this. Okay, this can hurt you a lot. Okay.
Yes.
But interestingly, you may be able to utilize both section 121 and 453 in unison on the sale of a primary residence. The example there would be you bought it for $500,000, $500,000 exclusion. It was always your primary residence, so you get $500,000. So now you really own it for $1 million, but you're selling it for $2 million. You got $1 million gain there. That's potentially $300,000 in taxes. Well, you use the deferred sales trust to take that over time. The nice thing is most lenders, if you have 3 to 6 months worth of proven payments and the payments are expected to last at least 3 years, they'll let you utilize those payments as qualifying income. So you deferred the taxes on the sale and then you use the income to help you qualify for your next house.
Brilliant.
Right. And so back to the 1031 exchange, this is a great strategy. This is real estate investors use this strategy all the time. I think they're typically pretty well versed. The challenge today is property values are so high.
Right.
And the competition is so great. I think that maybe I should say it differently. The competition to buy is so great and home values are so high, right?
Exactly.
If you're getting 20 offers on one property and you've got 45 days to identify the replacement.
Right.
And 6 months to close. Well, if you get outbid on 3 different properties, now all of a sudden you're starting to be in a pickle, right?
Right. Yep. Because they're able to identify 3 possible properties, correct?
Yeah. Yep.
Yep.
And then with the old 453 installment sale, this used to be a lot more prevalent. This used to be utilized a lot in the 80s when interest rates were 18%. Okay? And you'd have seller carry back their property and at 12%, you thought you're getting a deal.
Right, exactly.
And the funny thing about it is it was a deal for everybody. Everybody was winning there. The seller was making 12% on that amortized amount, and the buyer was able to get into a property for less than what the bank was going to give them. Today, utilizing the deferred sales trust, it's going to give you more control of the taxes you're paying. That it's all about control, and that's, if you're able to minimize current taxation, even stretch it out over time. What if you were in a situation where you were going to end up paying that $99,000 regardless?
Okay.
Would you rather pay it in 2021, or would you rather pay it from 2021 through 2041?
Exactly. Spread the pain out over some time.
Yep. So those are three good strategies. And like I said, they can be used kind of crisscrossed in unison. The 121 and the 453 can be utilized to sell the property. For primary, 453 and 1031 can be utilized to sell investment properties. What do you mean? I'm working with a guy right now. He's selling for a 1.8. The replacement property is 600,000. Okay, so he's going to push $600,000 in 1031 exchange and 1.2 in via the 453 deferred sales trust.
Deferred sale trust. Yep. Okay, so that's really a nice blend. That's a very nice blend. Instead of trying to identify multiple properties to close on and stay within the state of California, to be able to mix and match the two, a 1031 on a portion, deferred sale trust on the other portion, and have that nice residual chunk of money coming in every month.
Absolutely. And that's kind of a nice recap of what we've talked about. It's a great time right now to sell your primary residence and or your investment properties. Make sure you're aware of non-qualified use, right? You don't want to move back in.
Absolutely.
And know that there's several different tax deferral strategies out there. So for those of you who are listening, you want to get in contact with Jeneane, it's 858-229-1041, JeneaneMason.com. If you have any real estate questions, and if you have any tax questions, roadmaptax.com. You can book an appointment right there or contact us directly. I want to thank everybody for attending. Jeneane, thanks so much for hosting this.
Thank you so much for coming on, Jess. Just always a wealth of information. Appreciate your insight, your guidance, and very, very practical tips for assisting our clients out there.
Thank you so much. All right, y'all have a great one. We'll talk again soon.
All right, thank you. Bye.